How does a grid trading strategy benefit users in times of market volatility? Grid trading is a type of quantitative trading strategy designed to place orders below or above a set price in a range-bound market. How does a range-bound market look? A range-bound market is one in which prices bounce between a specific high price and a low price. The high price acts as a major resistance level in which the price can't seem to break through. The low price acts as a major support level, which the price can't seem to break as well. Investors typically chase assets with rising prices and exit from those with prices headed in the opposite direction to cut their losses. Due to the volatility of the crypto market, users are more likely to suffer asset losses when they are too fixated on market conditions. Grid trading strategy refers to the price range and the grid density managed by users themselves. The system will place orders automatically to avoid losses caused by users' emotion-driven trading. For example, if the current price of BTC is $20,000, the grid interval is set up at $19,500 to $21,500, and the grid density at $200. The bot is set to stop loss at $19,000 and take profit at $21,700. When the price of BTC reaches $19,900, the grid trading bot will automatically buy BTC. When the price of BTC rises to $20,100, the grid trading bot will automatically place sell orders, netting an easy profit for users. When the price of BTC breaks through the low price to $19,000, the grid trading bot will automatically sell all holdings to stop loss. When the price of BTC hits over the high price to $21,700, the grid trading strategy will be automatically ceased. In short, the key to grid trading is to buy low and sell high. It is an ideal tool for traders in a volatile market.